Why is revenue recognition challenging for long-term SaaS project accounting? Have you ever wondered why revenue recognition can be so tricky for long-term software as a service project accounting? Let's break this down in a straightforward way. Revenue recognition for software as a service can be complicated due to the nature of the contracts involved. These contracts often include various components that are delivered over extended periods. This means that accounting standards like Accounting Standards Codification 606 and International Financial Reporting Standards 15 come into play. These standards requiring revenue to be recognized as performance obligations are fulfilled, which can be quite complex when services last 4 months or even years. One of the main challenges is the presence of multiple performance obligations. In many software as a service contracts, you will find that they bundle software access, implementation, customer support, and professional services. Each of these elements may representing a separate performance obligation. This requires careful analysis of the contract to ensure that revenue is allocated correctly. Next, consider the subscription-based revenue model. Unlike traditional sales where revenue is recognized at the time of delivery, software as a service revenue is recognized over the subscription term. This means that revenue must be deferred and recognized systematically as services are delivered. This could be on a monthly or annual basis, making it essential to track subscription start and end dates, renewals, upgrades, downgrades, and cancellations. Another factor complicating revenue recognition is variable considerations. Many software as a service agreements include variable fees based on usage, discounts, or performance incentives. Estimating these variable amounts and incorporating them into the transaction price adds another layer of complexity, especially as customer behavior can change over time. Deferred or unearned revenue is also a significant aspect. Customers often pay upfront for services that will be delivered over time. This means that revenue initially recorded as deferred must be recognized gradually. If a customer decides to cancel or modify their subscription, adjustments need to be made, complicating the revenue tracking process. Upfront services like setup, customization, or training can further complicate matters. Depending on whether these services are integral to the software or separate obligations, the timing of revenue recognition can vary. Additionally, costs related to these services may need to be capitalized and amortized over the contract term. Lastly, long-term software as a service projects can span several years. This requires ongoing adjustments for contract modifications, renewals, or changes in service scope, which adds to the accounting complexity. From the perspective of finance software solutions, addressing these challenges involves implementing specialized accounting systems. These systems can automate revenue recognition processes, ensure compliance with relevant standards, and provide real-time tracking of contract terms and performance obligations. Integrating with billing and contract management tools helps maintain accurate records and manage deferred revenue efficiently. Training finance teams on the nuances of software as a service revenue recognition standards, and encouraging collaboration between finance, sales, and legal departments can further support accurate revenue reporting.